tax exemption refers to a monetary exemption which reduces taxable income. Tax-exempt status can provide complete relief from taxes, reduced rates, or tax on only a portion of items. Examples include exemption of charitable organizations from property taxes and income taxes, veterans, and certain cross-border or multi-jurisdictional scenarios. Tax exemption generally refers to a statutory exception to a general rule rather than the mere absence of taxation in particular circumstances, otherwise known as an exclusion. Tax exemption also refers to removal from taxation of a particular item rather than a deduction. International duty-free shopping may be termed tax-free shopping. In tax-free shopping, the goods are permanently taken outside the jurisdiction, thus paying taxes is not necessary. Tax-free shopping is also found in ships, airplanes, and other vessels traveling between countries. Tax-free shopping is usually available in dedicated duty-free shops. However, any transaction may be duty-free, given that the goods are presented to the customs when exiting the country. In such a scenario, a sum equivalent to the taxes paid, but reimbursed on exit. More common in Europe, tax-free is less frequent in the United States, with the exception of Louisiana. However, current European Union rules prohibit most intra-EU tax-free trade, with the exception of certain special territories outside the tax area. Specific monetary exemptions. Some jurisdictions allow for a specific monetary reduction of the tax base, which may be referred to as an exemption. For example, the U.S. federal and many state tax systems allow a deduction of a specified dollar amount for each of several categories of personal exemptions. Similar amounts may be called personal allowances. Quote, "Some systems may provide thresholds at which such exemptions or allowances are phased out or removed." Exempt organizations. Some governments grant broad exclusions from all taxation for certain types of organization. The exclusions may be restricted to entities having various characteristics. The exclusions may be inherent in definitions or restrictions outside the tax law itself. Approaches for exemption. There are several different approaches used in granting exemption to organizations. Different approaches may be used within a jurisdiction or especially within sub-jurisdictions. Some jurisdictions grant an overall exemption from taxation to organizations meeting certain definitions. The United Kingdom, for example, provides an exemption from rates and income taxes for entities governed by the charities law. This overall exemption may be somewhat limited by limited scope for taxation by the jurisdiction. Some jurisdictions may levy only a single type of tax exemption from only a particular tax. Some jurisdictions provide for exemption only from certain taxes. The United States exempts certain organizations from federal income taxes but not from various excise or most employment taxes. Charitable and religious organizations. Many tax systems provide complete exemption from tax for recognized charitable organizations. Such organizations may include religious organizations, fraternal organizations, public charities, or any of a broad variety of organizations considered to serve public purposes. The U.S. system exempts from federal and many state income taxes the income of organizations that have qualified for such exemption. Qualification requires that the organization be created and operated for one of a long list of tax-exempt purposes, which includes more than 28 types of organizations and also requires, for most types of organizations, that the organization apply for tax-exempt status with the Internal Revenue Service, or be a religious or apostolic organization. Note that the U.S. system does not distinguish between various kinds of tax-exempt entities for purposes of granting exemption, but does make such distinctions with respect to allowing a tax deduction for contributions. The UK generally exempts public charities from business rates, corporation tax, income tax, and certain other taxes. Governmental entities. Most systems exempt internal governmental units from all tax. For multi-tier jurisdictions, this exemption generally extends to low-tier units and across units. For example, state and local governments are not subject to federal, state, or local income taxes in the U.S. pension schemes. Most systems do not tax entities organized to conduct retirement, investment and pension activities for employees of one or more employers or for the benefit of employees. In addition, many systems also provide tax exemption for personal pension schemes. Educational institutions. Some jurisdictions provide separate total or partial tax exemptions for educational institutions. These exemptions may be limited to certain functions or income. Other not-for-profit entities. Some jurisdictions provide tax exemption for other particular types of organizations not meeting any of the above categories. Reciprocal exemptions. Some jurisdictions allow tax exemption for organizations exempt from tax in certain other jurisdictions. For example, most U.S. states allow tax exemption for organizations recognized for federal tax purposes as tax-exempt. Sales tax. Most states and localities imposing sales and use taxes in the United States exempt resellers from sales taxes on goods held for sale and ultimately sold. In addition, most such states and localities exempt from sales taxes goods used directly in the production of other goods. See also sales taxes in the United States, tax-free shopping, tax holiday. Exempt individuals. Certain classes of persons may be granted a full or partial tax exemption within a system. Common exemptions are for veterans, clergymen or taxpayers with children. The exemption granted may depend on multiple criteria, including criteria otherwise unrelated to the particular tax. For example, a property tax exemption may be provided to certain classes of veterans earning less than a particular income level. Definitions of exempt individuals tend to be complex. In the Ottoman Empire, tax breaks for descendants of Muhammad encouraged many people to buy certificates of descent or forged genealogies. The phenomenon of tzud, falsely claiming noble ancestry, spread across ethnic, class, and religious boundaries. In the 17th century, an Ottoman bureaucrat estimated that there were 300,000 impostors in 18th-century Anatolia. Nearly all upper-class urban people claimed descent from Muhammad. The number of people claiming such ancestry, which exempted them from taxes such as avarice and teklif or fiyya, became so great that tax collection was very difficult. Exempt income. Most income tax systems exclude certain classes of income from the taxable income base. Such exclusions may be referred to as exclusions or exemptions. Systems vary highly. Among the more commonly excluded items are income earned outside the taxing jurisdiction. Such exclusions may be limited in amount. Interest income earned from subsidiary jurisdictions. Income consisting of compensation for loss. The value of property inherited or acquired by gift. Some tax systems specifically exclude from income items that the system is trying to encourage. Such exclusions or exemptions can be quite specific or very general. Among the types of income that may be included are classes of income earned in specific areas, such as special economic zones, enterprise zones, etc. These exemptions may be limited to specific industries. As an example, India provides SEZs where exporters of goods or providers of services to foreign customers may be exempt from income taxes and customs duties. Exempt property. Certain types of property are commonly granted exemption from property or transaction taxes. These exemptions vary highly from jurisdiction to jurisdiction, and definitions of what property qualifies for exemption can be voluminous. Among the more commonly granted exemptions are property used in manufacture of other goods, property used by a tax-exempt or other parties for a charitable or other not-for-profit purpose, property considered a necessity of life, often exempted from sales taxes in the United States, personal residence of the taxpayer often subject to specific monetary limitations. Conditions imposed on exemptions. Exemption from tax often requires that certain conditions be met. Multi-tier jurisdictions. Many countries that impose tax have subdivisions or subsidiary jurisdictions that also impose tax. This feature is not unique to federal systems, like the US, Switzerland and Australia, but rather is a common feature of national systems. The top-tier system may impose restrictions on both the ability of the lower-tier system to levy tax as well as how certain aspects of such lower-tier system work, including the granting of tax exemptions. The restrictions may be imposed directly on the lower jurisdiction's power to levy tax, or indirectly by regulating tax effects of the exemption at the upper tier. Cross-border agreements. Jurisdictions may enter into agreements with other jurisdictions that provide for reciprocal tax exemption. Such provisions are common in an income tax treaty. These reciprocal tax exemptions typically call for each contracting jurisdiction to exempt certain income of a resident of the other contracting jurisdiction. Multi-jurisdictional agreements for tax exemption also exist. 20 of the U.S. states have entered into the Multi-State Tax Compact that provides, among other things, that each member must grant a full credit for sales and use taxes paid to other states as subdivisions. The European Union members are all parties to the EU multi-country VAT harmonization rules.